Hello.
Darren.
Are these on?
So just to stay on time tonight, if you could, please, you can either stand, grab a drink, take a seat, whatever you like. First of all, Darren Fisk, thank you guys very much for coming tonight. And most of all, thanks for your partnership. You know, the core foundation that we believe in at Forum starts with partnership. And those of you that have been our partners, whether it's been 6 months or 6 years, we couldn't do it without you. So thank you guys very much. To true Forum history, we do not want to have a presentation where we're walking through a PowerPoint, but rather have something that's what we call our coffee talk, where it's interactive, more of kind of a round table up here. And so tonight's meant to be a networking function amongst all of you. It's meant to be getting to know the other Forum team members and Forum in general. So we're going to try and keep it light, have some fun. We've got a magician for any of those that you have not seen. My favorite show of the night is The Magician. Everybody made fun of me, and now everybody wants him at their party. So I'll give you his number. So one of the things that we also do at Forum is we are in the business of investing. We're not in the investment business. And something that means so much to me is community, and that's our investor community. It's the communities we buy and build. And so most people have funds, and they're in the investment business. They have to put money to work. So I am the largest investor in these deals, and everybody here at Forum participates alongside with all of our investor partners here. So rather than being in the investment business, we like to say we're in the business of investing. Whether it's 4 deals we do this year, whether it's 40 deals, the market will dictate where those opportunities come from. So if you will, anybody with the red pen, Forum members, please stand up, just so if you're not in back.
They're all in back.
They're all in back. So, quick introduction. This is Shelby Noble. She runs business development here at Forum, and she's going to be our moderator. We have 2 microphones in back. So, Helani Ellis, if you'd please stand. Teresa. When you guys have questions, please ask. Don't hold back. Anything goes. Look under the hood and ask what you need. So without further ado, Shelby Noble.
Thanks, Darren. I'll also introduce the rest of the members here. To my far right is Don McKenzie, President, Kevin Foltz, our Managing Director of Development, Brian Shuman, who's our CFO, Greg Litvak, who's our VP of Acquisitions, and Ryan Brome, our VP of Investor Relations. So as Darren mentioned, we have several collections that appeal to all investor types. I think the best way to start tonight is really to give an overview of all of our collections. And I'll really start with Don with an overview of the Signature Collection.
So our Signature Collection is what it kind of sounds like. It's primarily developed assets that have a very signature appeal to the customers. And one thing that makes Forum unique is that we focus very heavily on branding and try and bring the brand concept all the way from the conceptual part of designing the asset all the way down to the execution of it, the lease up, and the management of the asset. So Signature is the high quality rifle shot investments in primarily developed assets.
And it seems like over time, Forum has developed a lot from the formation to today. Why now? Why does development still make sense in today's environment?
Well, it's definitely part of the headlines, certainly about Denver, that Denver's in a state of overdeveloped, oversupply right now. Fortunately, Forum isn't really part of that. We don't have anything to do with the massive number of cranes that are still in downtown. I don't know if you recently noticed, but in the last 30 days, there's another 1,300 urban apartments that were announced in the downtown market. So it just keeps going, and it hasn't yet stopped. And that's obviously leading to an overbuilt situation for that submarket. Our last 2 ground breaks have been, we're about to break ground in Tempe, Arizona, and we just recently broke ground a few months ago in Minneapolis. So that's a good example of we tend to stay very nimble in terms of development opportunities. So we don't look at development as a category per se. It's an area of our business where we see ongoing opportunity, and we'll talk a little bit more today about some of our forward development opportunities, but I think you're going to find them equally unique, equal rifle shot opportunities. They're not going to be part of the the overall market that you see occurring.
Thanks. Greg, do you want to touch on the Essential Collection and some of the successes that we had in 2016?
Yeah, so the Essential Collection is stable and recurring cash flow, cash flowing deals that we look for in the Midwest and Southeast primarily. Those deals are purchased pretty meaningfully below replacement costs, and there's very limited supply in a lot of these markets, which is really due to the fact that people cannot justify the cost of new construction because the rents are so low. So even if they are going to go put a shovel in the ground, they're typically shooting for the top of the market, which is not competing with a lot of the properties we buy there, which is really a lot of renter by necessity type properties. And then 2016, we bought 10 deals last year, so it was an active year. I attribute that to there being a healthy spread between cap rates and interest rates. But also through, I highly attribute it as well to a lot of our long-term relationships that we've built with owners and brokers. About half of the deals that we did last year in the Essential Collection were non-brokered, either direct through the seller or not publicly listed.
And how do you choose the markets that we're growing in or new markets that we're looking for? Where do you find those opportunities, and how do you evaluate those markets?
Yeah, so I think we all would agree that there's good deals in every market. Most markets have deals that are priced to reflect the risks associated with that market. For example, though, last year we entered Louisville, and we found two very attractive deals there that we liked, and they've proven to be good investments so far. But those are, rehab deals that received a bunch of money and took us into what we now, have learned to be a very good market. So I think that, in these secondary and tertiary markets, there are a lot of good deals in a lot of markets.
Can you talk a little about that rehab, the post-rehab story, why that kind of works in the Essential Collection?
Sure. So we buy a lot of deals from rehabbers. Reason being, there's a ton of money right now that's flooded to value add. Everyone wants to do value adds. Everyone has a big fund to go do value adds in, and those funds have fixed investment horizons. They're typically 5 to 7 year fix and flips. And if they can sell deals earlier, then a lot of the times these guys will, and so they can juice their IRR, their internal rate of return. We find that when we buy from groups that have recently value added a property, that there's occasionally meat left on the bone, so we can continue to push rents. And then the properties are also very well maintained. They've just had a bunch of money put into them and have little deferred maintenance.
So to add on to what Greg said, I think one thing that makes us unique is our investment horizon. We don't have one. We look to create value, and one way or another, we're going to unlock that value, whether it's a refinance, pull money out, whether it's a sale, versus the majority of folks out there, they're funds. They have an infinite life. And it's like going to Vegas and saying, hey, I'm only going to play blackjack when it's 21. I can't time the market. All we can do is try and be cautious, put great long-term debt, have high debt service coverage ratios. These other groups are, as Greg said, putting $36,000 a unit, and their fund life says, look, we have to sell it. It's year 7, I'm sorry, we have to sell. And we say, thank you very much. You did all the work. And as Greg said, there's a lot of meat left on the bone, and we're looking for these cash flowing assets. And I think that's one difference from what has changed from our tactics from what, say, 4 or 5 years ago, when we could buy anything anywhere and get great cash flow. Today, there's so much money globally chasing real estate that we're seeing these funds start to play in our playground, our sandbox.
Well, and one of the unfortunate things about our industry is that pretty much, we just got back from ULI 2 weeks ago, pretty much 90% of what you heard was everybody continues to believe in value add, the entire industry, and yet they will explain that the pricing of those deals is priced perfectly. The seller is receiving all of the value. So it's kind of weird. Our industry is always like that. It's got quite a bit of activity that if you're just going to follow that pack, you're going to be very, very crowded and a lot of people doing the exact same thing. We're kind of playing the opposite side of that, which is working out very well.
And we do have a collection, the Premier Collection, that kind of, we've historically said it's some value add, the potential of value add. What do you think about the Premier Collection today, and how does it relate to the Essential Collection?
So I think the Premier Collection in our mind is something along the value add side, or another way to say it is we're shifting our tactics within Premier where we can find more of these primary markets, use lower leverage. Denver's a great example. As Don spoke about, the overbuilding in Denver is in some main areas, Cherry Creek, downtown. But when you look at the amount of population growth in Colorado, it's all happening around the suburbs. And I like to say, let me drop a pin here and go 20 miles around this city, and let me show you where everybody's actually moving. So with the increase in construction costs, it's prohibiting new development. My crystal ball says you're going to see development shut off pretty quick here because people can't justify new construction. Yet we've got 9,000 to 10,000 people a month moving to our state on this Front Range. So to me, again, shifting our tactics where we can find newer assets in more primary markets with lower leverage. Again, I see it more as a value play versus our Essential Collection is a current income cash flow play.
So that's our multifamily collections. I think Kevin can talk a bit about the business collection and some of our commercial assets.
Yeah, the business collection is a smaller but very strategic and very significant arm of our development platform, really adding on to the principles that Don explained on the signature collection, really being laser focused on location, one-of-a-kind assets, one-of-a-kind opportunities. And it really has led us into the commercial market, building on job growth and what's happening and diversifying our portfolio. These opportunities, surfaced in a couple of our recent developments, the Park DIA development, and of course our signature or premier commercial asset is Pearl Place in Boulder, build to suit for Google. The returns on these projects can be staggering. That one is going to deliver, if we sold, it would be a 4.5 equity multiple, and it would be somewhere around an 11% cash on cash out of the box. So while those aren't representative of every commercial deal or every business collection opportunity, it certainly shows the potential. And it also has led to, as Darren mentioned, as the job growth and the population growth in Colorado continues, it's led to other opportunities for us as far as build-to-suits and some of those development opportunities.
Well, and Kevin, to your point, I think it allows us to really leverage kind of that in-house development expertise. Google's a perfect example of a project where, you've got a single tenant, you've got a lease in place on a 15-year basis, and you're really building core and shell. And so, we're able to kind of come across these opportunities, take that rifle shot approach, but we're not really in that business to say, oh, we have to go find that to keep the company alive. So we can be more strategic from that perspective. And so again, being a multifamily shop that has just this unique kind of business collection, I think is something that is a differentiator for our model.
I think to add on to what Ryan said, that's, again, part of the secret sauce is we're nimble. We don't like to be pigeonholed into one box. And having the different collections, being able to diversify within our own real estate portfolio, when it's time to develop, we'll develop. When it's time to buy, we'll buy. And when it's time to sit on our hands, we'll sit on our hands. So we don't have that pressure to put money out. And, skating where the puck is going is what we always talk about internally. Where are the trends? What's happening? And I think that's been one of the keys of our success.
So we've talked about the attributes of finding a deal, developing a deal. Can you walk through a little bit of the kind of asset management perspective of it? So going from acquisition or development through kind of owning and operating the asset.
Shelby, to get to that, let's talk a little bit about the risk with that. So we have an investment committee approach that is a little bit expanded from what we've used to do. Today, Greg or Kevin or Don, if they're going to be bringing a deal, an acquisition or development deal, they're going to bring it to our investment committee. And we're going to have a chance to really dive into the numbers. That'll allow them to take the deal out to the market, and if we're awarded best and final, we'll do a due diligence. And we'll do due diligence with our property management company, with the asset management company, and with ourselves. We'll then bring it back, and we're going to come back to another investment committee meeting. And at that point, the asset manager is going to stand up, and they're going to have to really wave their hand and say, can I buy this property and run it for the next 10 years? As you've heard, we're a very different company. We believe that we're investors and we have partners, and we want to be in these assets for a long time. And so we don't want to just buy well today. We have to do that, but we have to also own it well for the long term. And so the investment committee approach is about taking risk off the table, making sure everyone has a voice, and the acquisition and development team is really focused on bringing a good deal, and the asset management team is focused on operating a good deal with our property manager. So, as we get into how we actually asset manage it, I think how we get it on board is important too.
Absolutely. I think that acquisitions and asset management really work hand in hand at the company as well. We're really all part of what we call an investment management group, just to show you how closely we really do work together. And Andrew Davis is really my counterpart to that. But I think, first and foremost, we have great management companies, and they have meaningful scale. So Village Green is our partner in the Midwest. They have about 50,000 units under management. They have meaningful scale in the markets that we're in. That helps for efficiencies. That helps when you're buying a property. There's not a learning curve. There's not a new team that's being hired. They can dive bomb with people who've been with that company for an extended period of time. And we have a similar group in the Southeast that we use in Stonemark. Beyond that, we also used to have our own management company, and a lot of us, we all think like owners for sure, but we take we know how to keep our management companies honest, I guess, and stay very involved and take a granular approach to asset management.
And I think that kind of leads to a little bit on kind of the marketing that the company does. I think you mentioned, Don, about development and how marketing kind of starts in-house. I think that marketing plays a big part in the property management as well. I don't know if you can talk about how we're different in the fact of our in-house marketing and branding teams.
Well, it's something we're definitely growing quite a bit. Ben Ray is here tonight, and Teresa Hansen is back there. We've made a significant commitment to in-house sales and marketing. It's something in the apartment business that is, again, kind of the opposite of the way most people do it. But our perception is that the customer contact, how we locate the customer, how we market to the customer, how we price, and how we close to the customer is something that we need to be very focused on at Forum, and not just with the third-party management company. And it goes for development as well as acquisitions. On the development side, it's a little bit clearer how it works because we have a very, very clear perception about what the brand of the asset is and where we're trying to connect to customers. As Greg described, some of our essential collection is more middle market renters by necessity rather than renters by choice, so it's different in terms of how we approach that marketing. But both of them come together in terms of digital marketing, where the customers who are searching for apartments today are looking for their apartments in an entirely different way than they did 10 years ago. And we have to pay attention to that, and we have to make sure that we're optimizing that rather than just allowing that to happen with some third party.
Thinking a little bit about kind of managing the assets, I see the chart on the screen right now is about our risk indicators. I don't know if, Brian, you kind of want to talk about our financing and how we think about interest only, amortization, how that makes us different.
We try to take risk off the table, right? We've talked about it from the investment committee. We put insurance on the properties, of course. We think about risk in a lot of different areas. Certainly the capital stack is an area where risk is exposed. We focus very much on long-term, fixed-rate, interest-only debt for 4 or 5 years. We want to be a long-term owners. We want to have a long-term strategy around our finance. We also believe that this notion of loan-to-value, someone's 80% or 60% loan-to-value, we think it's the wrong measure, or at least it's one of the wrong measures when you think about the risk. Debt coverage ratio, and I know Darren talked about it earlier, debt coverage ratio really talks about the ability to cover your debt, right? And so whether one's being subjective on the valuation, you can't be subjective on your cash flow. And so we want to make sure that more important than loan-to-value, we've got debt that's long-term, fixed rate, and we will trade off a little bit and take interest only for, depending on the term of the loan. 12-year loan might have 3 or 4 years of IO. We'll accept that risk because we have a high enough debt coverage ratio, at least 2 points times cash flow. So we think that there's risk in real estate. We think that we manage that risk both as we buy it and as we operate it, and certainly as we create a capital stack around it.
So debt's a great thing, but there are two ways in real estate people get in trouble. Their debt comes due or they're over leveraged. If we have no debt, you may be servicing some taxes, but most people in our industry, what they do is to make their numbers work, they start going shorter in term, whereas we go longer. So they're playing, with the bullet there when that loan comes due in 5 or 7 years. I don't know in the last 10 years if we've done anything shorter than 10-year fixed rate. New deal we have coming out next week, we're going 15 years. We may do 5 years interest only, amortized for 10 years. What this chart up here shows is if we start year one with a 10% cash on cash return, and after 4 years of interest only, we want to be at that same initial year one return. So if it's a 10 in year one, when it starts amortizing after 4 years, so in year 5, we want to still be at that 10. You're going to have a drop. Over those next 8 years, we're going to amortize that loan, meaning pay the loan down, assuming 0 appreciation in 12 years. When that loan comes to maturity, we'll be at a 63% loan to our original purchase price. So that's the way we look at risk, is where are we going to be if we take this to maturity? If values decrease 10%, where are we going to be? If values increase 10%. But again, we're just looking at a flat line assuming 0 appreciation.
Just want to remind if anybody has any questions, please feel free to ask. We'll
About
switch.
the magician, anybody?
Darren, one thing I'd add to that actually, so we take a conservative approach to debt. Having said that, we're also always scrutinizing whether or not we should be recapitalizing the deals, whether through a refinance, a supplemental loan, or a sale. And one deal in particular that's relevant is Seasons Park, which we're selling to. We were intending to sell it to a value add shop that was going to sort of blow the doors off and pay a 5.5 cap for a 70s vintage deal in a B- area that we bought from a bankruptcy trustee, which is a pretty low cap rate. And then an affordable group came along and actually offered $3 million higher because they wanted to keep the affordable units online. And so, what you say, when the ducks quack.
The ducks quack, feed them.
Yeah.
But I think it's important to mention, though, that, that was an unsolicited offer. So, to Darren's point of, we try to unlock value, we're a long-term holder of real estate, but we don't pick when we sell because guess what? We don't know where cap rates are going to be 5 years from now. But in being a long-term holder, if you receive an offer that ultimately is too good to be true, and then you're a seller. And so I think from that perspective, we can take advantage of that because we don't have a term that we're up against.
So, Cindy.
With the building defect law changing in the last couple of weeks in the state of Colorado, how is that going to affect the multifamily and the development of multifamily units?
You want to repeat that? You want me to
I
repeat
just,
that?
That's okay. With
we can
the
re-
state of Colorado just releasing the building defect law for apartments and condos and townhomes, how is that going to affect multifamily and development in Colorado?
I think the truth is that we haven't seen a lot of condo development in Colorado, not just because of the construction defect liability law. The main reason is because the rental multifamily business has been so good up until about 6 months ago. And so I think the law will help and it will start to change things. It really just changes some of the habits or relationships between the developer and the individual homeowners and how they relate to each other. It's not a full step toward really solving the liability issue. So we'll see, I think when the governor makes the announcement next week, there'll be 4 or 5 developers standing behind him announcing large condo projects. So it's going to start happening. We're going to see some condo development, but they really haven't fixed the core issues of the liability yet. So it'll probably increase the amount of development, but I don't think it's going to lead to a flood. And then in the end, it just has to do with how many people are out there who really are interested in being renters versus interested in being owners, and the cost differences between the two. Because, as I said, it's not just the liability law, it's also just been a great business, the rental business, up until very recently, the building business.
Thank you.
Ryan, do you want to talk a little bit about kind of capitalizing our Do we have another question?
I think there's another question
Oh.
back there.
So when you choose to sell, I actually have two questions. When you choose to sell, will you be thinking about the tax ramifications for the return of capital? And also, the second question is, if you refinance, does that create a requirement for 1031?
So great questions. First of all, let me give you my philosophy on whether to sell or refinance, because Seasons Park, as Greg mentioned, I'll give you that as an example. If I had invested $100,000 and I'm getting a 10% return, I'm getting $10,000 a year. The way I look at it is, if my $100,000 when I sell is now worth $200,000, I need a 5% return to get that same $10,000, so we're status quo. So I don't want to sell a child to go buy, a stepchild that I don't know. Sorry, no offense to anybody. So anything,
It was inevitable.
anything, I know, anything incremental from there. So if all of a sudden I'm getting $15,000 a year, I just got a 50% bump. So I'm always trying to turn my dollar in 1031 into $2. So I want to turn the $10,000 a year into $15,000 or $20,000 a year. So it does make sense from time to time to pay the tax, because I'm not a believer in just deferring. At some point, we're all going to have to pay the piper and pay that tax. Secondly, why I do like refinances so much is that you defer the tax. When we pull, let's say that we returned 100% of your money and it was a $100,000 investment, you're deferring that tax. We still own that property. You've got another $100,000 in your pocket to go do what you want. You can invest, but you're not required to 1031. That's not an exchange. So you've got to bifurcate those two processes.
So that is the bottom line, is that when you return a refinance, say 100%, is that there's not a tax ramification.
Today, you're deferring it
Deferring it till
until an
sold.
eventual sale. And at that point, you could 1031 your proceeds.
Because I've gotten some contrary info on that, and I was just curious as to if you've heard something different possibly.
We have tax counsel here. Daryl?
Yeah, where's Daryl? He'll be at the bar later.
That's right.
So return of capital is not a requirement to get invested again within a time frame?
So the answer was no.
Can someone put a mic on Daryl?
Confirmed.
Yeah.
Any other questions while we're...
All right, Ryan, do you want to talk a little bit about capitalizing deals today? We have a lot of investment partners here. How we're thinking about raising money going forward, what the environment looks like today.
Yeah, well, so I think this room is a great example of kind of our philosophy. We take that long-term approach with investment partners that really have that same kind of philosophy in terms of what they want to accomplish with a real estate investment. So, we traditionally have operated in this friends and family space, and, frankly, I don't see that changing. We want to have people that have the same objectives as we do as investment partners. We'll continue to focus on the family office and high net worth space because, one, it allows us to be strategic and it allows us to be nimble. We raise money on a deal by deal basis, and so to the extent that people opt in for an opportunity or they don't, they can make that determination and it meets kind of all of their specific requirements. So as we continue to grow, we really do function off of a referral business. Our business is based on, all of our investors bringing in additional people to say, hey, I've made money with these guys, I trust them. And for us, that goes a long way. That really is the way that this business has been built. And we're going to continue to focus on that because, frankly, that's the best partner that we can have. And it allows us to have that consistent capital base so we can execute on exactly what these guys do.
I think that's what makes Forum a little bit different too, in that, as everybody's alluded to, we don't have an investment horizon. I think that's, when you think about a hold period, having friends and family as investors, we don't have that same structure where you have to sell at 4 or 7 years.
Yeah, and actually we were talking earlier today, and Greg brought up a great point in that 2009, there was an incredible opportunity to buy a bunch of real estate at a deeply discounted value. The institutions were nowhere to be found, but ultimately we were able to go out and actually raise money for those opportunities. And frankly, guess what? There's going to be a correction in the cycle, and we're going to be ready with our investor base to capitalize on that.
I think 2009 was a great time to buy. I think, talking about Forum in general, what do you think was our best success story to date?
So I think you have to look at two things. One, I think the success story is everybody that we have in this room. We built a great company, proud of it. Second, I would say on the deal level, it's probably Boulder. Boulder is 30 square miles surrounded by reality. We have some Boulderites here, so went to school there. It's dear to my heart. But
Harvard of the West.
yeah. So from a success on the deal, or we've developed 6 assets there, soon to be 7. We have been able to navigate that field in Boulder. We love that market. So do a lot of people. And whether we're buying or building, we have that long-term horizon. And Boulder was one of those markets where, when the state of Florida teachers comes and makes you an offer and says, look, we'll give you 30 years of cash flow today, it's how quickly can I sign? So Boulder's been a great market for us. I also, think that there are other opportunities and markets to come, but I'm proud of both what we've done as a team and what we've done in Boulder.
Looking ahead a little bit, what do you see as the greatest opportunities for the rest of this year into 2018? Is it new property types? Is it new strategies?
So look, I'm a believer there's opportunity, whether it's a good market or a bad market, you just have to search for them. To me, one of the things, my background's real estate finance, did it for 13 years, and we think there's a great opportunity with Freddie Mac and the debt program. It's a great add-on. Today, we're in the process that will launch before the end of this year. It's called the Freddie Mac K Series. We can get an unleveraged, meaning no debt, 10% return paid monthly. We have all the equity ahead of us, so that's something I'm very bullish on, and we're going to offer up to everybody before the end of this year.
I think additionally, there's going to be more and more of this post-value add product coming online. We're seeing, I think, the front end of it, but there are so many of these value add shops with just massive funds doing these value adds. Some are going to work out, some are not, but we're going to see more and more of those, I would say, high quality assets for sale in the years to come.
And I think that you alluded to kind of the Zoom product.
Mm-hmm. We've had a project for about the last year called Zoom, is our code name, and it's really a focus on the 55 and up rental market. There's a slide on this, but you basically have this massive imbalance in the apartment market. This slide is of the next ground break that we have in Golden, and then there's another slide that shows the basic imbalance. Most of the apartments that have been provided have not only been very urban and dense, but they've also been almost exclusively targeted for millennials. And in the next 10 years, Colorado is going to have 500,000 additional residents who are in the 65-year range. And that's going to be half those that have the unfortunate age of aging into that group, like myself, and half coming in from the outside markets. And that really provides a very significant renter group. We think a lot of those people are renters. They're either going to experiment with that next home, or they just outright are not interested in the equity, debt, maintenance, and all the rest that comes along with owning a home. So we see a very significant opportunity. It's an area of the marketplace where there's very little supply. There are very few companies who have figured out how to supply to that market and what that market's looking for, and it's kind of tailor-made for Forum, where we take the customer extremely seriously and then customize the developments for those customers. So we're very excited about that opportunity. We think it could lead to quite a few properties, and as Darren said earlier, we view that primarily as a suburban opportunity. There's a lot of great municipalities in Denver where this is going to happen, and it's not all going to be in downtown, that's for sure.
We're also seeing the business, on the business level, the build-to-suit opportunities that are coming out of our success in navigating the Boulder community, and a lot of these companies, as they're growing and expanding, see that as an area, a great area to grow into, and need a development partner to get through that process.
And that Zoom product the first one will probably start to market in kind of June, July of this year. So.
Right.
A lot of people. Oh, we have a question.
I'm curious, millennials. What's your thoughts around how the multi-generational shift in the workforce is impacting the real estate market, where millennials are focused on lifestyle, living and playing?
I guess I can take that one. The millennials, no offense to any millennial here, but I call them the entitled class.
I don't know what you mean.
Sorry, I'm sitting next to one. Actually, he's not a prima donna, but look, what they value is travel and taking a picture on Snapchat and Facebook and showing it, to all their
Only
friends.
partially correct.
And so, I almost feel like these guys should go live in Europe and take a siesta every day and have no productivity. But I say that jokingly.
He hasn't thought
Sort
about
of.
this at all, I promise.
There's only so much of this that we can script.
So what is interesting, and with some of our developments, and most of the millennials are coming into the urban core, and like our Logan development, it's a crash pad for these people. It's a 1-bedroom, it's a studio. We have a bike kitchen. They want to be in the mountains. They want to be out playing. And the problem that we're starting to see is the cost of, as I've said before, new construction. These millennials can only afford so much. I mean, $3 a square foot, $3,000 a month on average is a lot of money. We just see that's where the softness is becoming as it relates to multifamily, is $3 and $4 rents in Cherry Creek. We thought our Kent Place development was high. We're getting $6,500 for a 3-bedroom. And to Don's point, the 55 plus, they're willing to pay that. The millennials are starting to feel that pressure in pricing. And you read the papers and they always talk about how all the growth is in the urban core, but when you look at the actual data, it's the suburbs.
But our research is that the empty nesters and the boomers really want a very similar thing to what the millennials want. It's really very similar. The physical asset could be almost identical in terms of amenities and that kind of thing. The units are going to be larger, obviously. The unit mix is going to skew toward larger. We think the parking becomes very important, secure and climate-controlled parking that's accessible to elevators. Kent Place is a perfect example. We saw over and over at Kent Place that some of the older residents, some of their favorite people on campus were the very youngest residents. And they really like that. They like that interaction. So what you're going to see us do as we enter very purposefully and programmatically doing more and more of that is we're going to mix those age groups. We're not going to exclusively go for one age group. And that's a mistake that's being made in the very few developments that are being done that are aimed at the boomers. They're skewing to late 70s because they're not getting it in terms of trying to mix that community. So we really think we can take a very large demand group that very few others are providing any product that makes sense to, and Forum can really apply its expertise to that. Kent Place is a perfect example of doing that.
Where do you think we are in kind of the real estate cycle today? Everybody kind of uses that, the average real estate cycle is 7 years. We're at 7 years this year. Where do you think that we are?
So great question. What is history? I guess this is where I can get going. When people say, well, historically interest rates are low, well, what's historic? Is that from the 1900s to the 1950s? Is it from the Industrial Revolution? So many people forget about 2007 because it was overshadowed by 2008. But when you talk about history, this is 10 years old, okay? In 2007, Snapchat, a company named Uber, a new company called Facebook, go down the list. All these things happened in 2007, and they were overshadowed by the downturn of 2008. With the exponential growth in our world today and how fast things are changing, I don't know what history really means. I don't personally believe interest rates are going up. You guys can think I'm crazy. We can take bets on this, but we have so many global investors coming to the U.S. for safety. Manufacturing jobs, we're bringing them back, but it's actually going to be robots handling the manufacturing. So our biggest shortage in the multifamily world is blue-collar labor right now. I think the cycles are getting longer and longer. There's one thing about multifamily, why I'm biased. You cannot live in your retail center, and you cannot live at your office. You can shop from home and you can work from home, but the necessity of living is never going away. So with Amazon, I just think this world is changing so fast. It's like watching the conveyor belt at the airport and your bag's going 25 miles an hour and you don't know what happened. And so I just think I'm cautiously optimistic as I look into the future. We're trying to be prepared for what's to come, but none of us are going to be able to predict. I don't think the downturn like we saw in 08 is going to happen again. I think there are too many regulations from the banking world, Dodd-Frank, Basel III, et cetera. So, again, we're going to start in the cycle. I think it's very pricey, but yet I believe in my lifetime yields are going to continue to come down because there's so much money chasing yield. And if anybody has a great spot because I don't think fixed income, I don't think bonds are a great return, I don't think equities are a great return. You talk about what happened today, the stock market was down 300 and 350 because the orange guy in the White House, got in trouble. And
Two strikes.
that's 2 strikes. I get 3 and I'm done. So, but look, the 10-year Treasury that is our benchmark went up almost 100 basis points after he got elected. There was no real news except that there was hope. And so we're starting to see those Treasuries inch back down. So to me, I actually am a big believer in multifamily and the need for housing because I think as our population continues to grow, we're fighting construction costs, which means vacancies are going to start dropping and rents are going to continue to go up. I think that's our 5-minute call. So
Questions?
let's take questions.
Yeah.
While we're in the crystal ball mode, I have read recently a couple of articles about the speculation of whether or not the depreciation might become into an issue in the new tax law, the new tax programs that are being developed.
Daryl.
So that would be pretty disastrous for this crowd.
That would be very troublesome for this crowd. Number one, taking with the interest rate deduction being gone or front loading all the depreciation the first 5 years would be a great thing initially, and then it would hurt over the long term. Again, this is all speculation, but Mr. Trump is a real estate guy. I know he has used those tax codes to his advantage. So I find it hard to believe that he's gonna, you get away from the 1031. I mean, you want to talk about a disaster and throwing us back into a tailspin in the wrong way, that would do it.
Real quick though on that, there's been so much conversation about depreciation or carried interest loss or tax rates themselves going down. We don't have it up here now, but at the end of the day, we try to focus on good economic real estate decisions. And so while we have no idea what's going to happen on the appropriation side or the government side, if we can get a 10% return out of the box in cash, we can allow a little bit of that government uncertainty to exist. We're still providing 10%. No question real estate is such a tax-favored investment. But at the same time, 10% real cash-on-cash return is not a bad thing either.
Any other questions? Nope.
What scares you right now?
Oh, geez, my 3 kids. I don't know. I always tell everybody internally, the question was what scares me right now. I always tell everybody internally at Forum that when I'm worried, you should be really calm because that's a good thing. And if I'm really calm, you should be really worried. So I'm always thinking about how we get in trouble. That is what keeps me up at night. From a financing standpoint, from just the risk, I take it very personally. We've never done a capital call. We've never lost anybody's money. I don't plan on ever doing that. Could it happen? Yes. But those are the things that keep me up at night is how do we get in trouble? And we're not, again, pressured to put money out. So my own personal philosophy is when I find a great deal I want to bring my buddies along. And it's different than I think you hear from most people. So hopefully that answered what
Well,
keeps
and
me
a
up
lot
at
of
night.
traditional multifamily companies are in difficult straits right now figuring out what their next steps are. The merchant part of the development business is definitely not going to do well over the next few years. And in fact, we'll see a lot of those people exit Denver. And this lemming activity in our industry of everybody deciding that they're all going to do the exact same thing, that's still very prevalent. And we're definitely seeing, the costs on the replacement side, really it would be hard to describe them as going up any more quickly than they have. So that's creating some real difficulty for sure. You know, I just joined Forum in the last year, and one of the things that really attracted me to Forum was how nimble Forum is and how it does not have a fixed commitment to business lines in a way that most companies really do, particularly most multifamily companies. So that was a big attraction point to me.
And Ryan, you had something similar to say about that earlier today.
Yeah, I mean, one of the things that I think is, really different for us is our structure, right? I mean, so we are not the traditional 220 model. We're not charging 2 on your commitment. We're putting everything into the transaction. And for me, it was really interesting when I was introduced to Darren. The first thing that we talked about was structure and philosophy, and that was a big piece that actually really drew me to the organization, because I said, every single day I'm on the phone with our investor base, with our partners, saying, this is why we do what we do, this is where your money's going, and then this is how we make money. And to me, it's probably the easiest thing to defend, because ultimately, everything that we get out of the transaction is on the back end. It's when we actually did what we said we were going to do, and we've hit a performance hurdle. And I really, fundamentally don't think that exists in today's real estate market. You don't see a lot of sponsors that are saying, you know what, hold on, don't pay me today. Pay me 10 years from now when I actually do what I said I was going to do. So to me, that's, again, following on what Don said.
We've got one or two more questions right here. She's running.
Based on what you just said regarding the merchants moving out, what does that say for the Castle Rock?
I think, so Don's referring to merchant builders, which people are building in a multifamily business, good market, bad market. They get paid based on fees, so they're the contractor, they're the developer, they're the property manager. So not retail merchants, but merchant developers. So I do want to say, we were trying to keep this to 45 minutes, keep it fun, entertaining, and move on. So any other questions? Take another 1 or 2 questions.
We got in the back.
So 10 years from now, if you had to predict, will the Essential Collection, the Signature Collection, the Business Collection, which one do you think is going to be the big winner, the big story? Or will it be a hybrid?
Well, I guess the question is, how do you define a big winner? So the greatest lesson, and many of you have heard me say this before, was from my father-in-law, who's not here tonight, unfortunately. He's hiking in Moab, but he said, Darren, if there's one thing in life I ever want you to remember, it's this. And I thought he was going to say, you screw with my daughter, I'm going to kill you. So shrugged that one off, and he said, and I truly believe this. He said, cash is king, but cash flow's queen. Wake up next to the queen the rest of your life, and you're going to be a happy man. And so, that has been my investment philosophy. And so whether it's investing in energy or other passive incomes, my question is, hey, how much cash flow am I going to get from this? So hard to say. Look, the developments, I can tell you one thing. When you build in core legacy locations, and we take the approach that we do in branding and identifying our demographic, like an ethnographer, we want to understand their sentiment, their ideals, the way they think. Before we ever break ground, we have a 70-page brand book, and it identifies the colors, everything that this demographic that we're building to. It's like if you were to build a single-family home, you wouldn't say, hey, designer, good luck, tell me when it's done. You'd spend time. We're just doing that in mass on the development side. So when you find these marquee locations, we create a ton of value. We've always said we're going to build to hold. JP Morgan came knocking on our door on Kent Place, and when the ducks quack, it takes us 25 years of cash flow again to get what we can get in cash today. I'm a seller. And so on the Essential Collection, I think that's the thing that I'll take to my grave and hopefully give to my kids and just hopefully keep building up more and more.